Good afternoon, ladies and gentlemen. Welcome to Business Today Television's special show, Market Guru, where we get you to meet the finest brains on Dalal Street. People who've made money over long durations of time in bull markets, in bear markets, in momentum phases, as also at times when the market is in a grip of a sideways trend. Our guest today is none other than Mr. Jyotivardhan Jaipuria. He's the founder and managing director at Valentis Advisors Private Limited. For the last 36 years, Mr. Jaipuria has spent time with ICICI Bank between 1986 and 1994. He was the managing director for Bank of America Merrill Lynch for about 21 years, and then he went on an entrepreneurial journey founding Valentis. Namaste Jyoti ji, what a warm welcome the markets have given you. Your presence has seen 25,000 on the Nifty, and no better day than this to welcome you. How do you see sentiment on the Dalal Street against the background that we might have rate cuts very soon in Wall Street and possibly followed in India as well?
Yeah, so Shail, it's of course been like a great journey. Last few years have been great for the market, and so sentiment is obviously very, very positive. For us, normally we always look at sentiment as a bit of contrarian indicator. So to that extent, I would be a little cautious. It's definitely a time where long-term money will still be made because India is like in a good phase on the economy. India will be the fastest growing economy over the next few years in the world. There's a lot of macro factors which are very stable today. So if you think of a fiscal deficit going down and actually meeting all the targets, and in fact beating targets most of the time because tax collections have been good. You think of your current account that's well under control. Growth numbers are looking good. Inflation numbers are as low as we've had them. So, a lot of the macro factors look positive. At the same time, I guess for you, me, and everybody else in the market, the concerning thing is just the valuation. They're definitely not cheap.
Yes, that is true, Jyoti, but the fact remains that the price on stock prices is always given by the market, and we are merely price takers at this point of time. Nevertheless, you are a very well-known stock picker. Even at current levels, where are you deploying fresh funds? For the benefit of viewers, I might add that Jyoti manages 1,600 crore rupees over two schemes in Valentis Advisors. Rising Star, which is a small cap and a mid cap scheme, has 1,000 crores invested, and a multi cap fund has 600 crores. So where is fresh money going in?
Yeah, so us, like we done a strategy, and like a lot of our philosophy is what I call the 3 U's. So we do undervalued stocks which are underowned and underperforming. So we are very happy to go where the crowd is not there. So for us today, what we are trying to do is one is look at sectors where there is value even now. So it's tough to find value, but at least the relative value, even in the absolute sense, there's value. So, the P of our portfolio today, if we take, for example, the Rising Star, and everybody says small caps are very, very highly overvalued, but we kept the P of our portfolio at around 16. So, which is like, reasonable even in normal circumstances. Second is within, like, if you talk of broad sectors, there's some sectors which we own, which in general have become expensive. Like we were the very early ones to buy capital goods. They become expensive, they're not cheap. But within our, like the whole capital universe, we probably have some of the stocks which are relatively the cheapest. We've been buying a bit into the banks because that's one sector which actually looks cheap on a very standalone basis. It's not doing well. Obviously, there are concerns on the deposit growth, and so because of that, probably credit growth will slow down at some point. But the fact is that they are very, very cheap at the moment. You get stuff cheap only when there are concerns around something. So for us, it is, this is the time to start nibbling into banks, and we think over the next 3-4 months we'll be adding to banks. The other thing we've been adding to and continue to like be bullish on is the pharmaceutical. So pharmaceutical is one space where there's growth. Valuations are relatively reasonable, even in the absolute sense, you get some things which are reasonable. So that is one more stuff which we've been adding.
Okay, let's address this thorny issue of banks, Mr. Jaipuria. Obviously, there is a tussle for deposits, as you very rightly mentioned. There is also this fear in the market that over the next maybe 3 or 4 quarters, NIMS, which is net interest margin, will contract mainly on account of excessive competition as also this rush for deposits.
Yeah.
Are you going towards private sector banks where truly not much money has been made over the last 5 years, or is the PSU pack attracting you?
Let me first address the two issues which you raised. One is the deposits, and there's a lot of noise about deposits are not coming because everything going to the stock market. That by itself, I think on a very broad macro wise, it is not true. The deposit growths are slow because RBI has kept money policy tight. So if RBI loosens the money policy, the deposits will start growing. Now, NIMs are a bit of cyclical issue. NIMs will
Yes.
contract for the next 2 quarters anyway, because anytime when there's a rate increase cycle which starts, your loans start to reprice immediately. Your
Yes.
deposits take a long time to reprice. So 18 months back, we got a huge surge in NIMs because the loans were repricing. And now we are getting that contraction because the deposits are repricing. Now, when the reverse cycle happens, actually the first phase you have NIMs which contract because your loans start to reprice down, your deposits don't reprice down, and at some point deposits will reprice down. So I think that thing will probably take, like you said, 3-4 quarters, but it will get sorted partly because RBI will ease liquidity and that will help deposit growth. And secondly, this whole cyclical phenomena will go away. Now, from our point of view, when we look at banks, typically we tend to look at corporate banks versus retail banks rather than private sector and public sector.
Okay.
And within that, like everything comes down to valuation. So at the moment, we are finding pockets of opportunity actually more in the private sector because that's where the stuff is very, very cheap. Even in the small cap or the large cap, we can find a lot of things which we think in a very absolute sense in a normal market also, the stocks would make sense buying at these levels. And of course, this is not something which is going to go up in a hurry, but we are very
Yes.
patient investors. We tend to buy stuff very early. So for us, it is you start nibbling from now over the next 3-4 months, and you'll probably make a lot of money after that in the banks.
Okay, perfect. And in any case, we are in an uptrending cycle as far as GDP is concerned. Private banks, in any case, will grow probably 1.52 times the GDP growth. Okay, that's a very clear investment thesis you have. Mr. Jaipuria, how about pharma? You say that this is again a space where relative valuations are better off compared with other sectors. What are you nibbling into pharma? Are the generic players focusing on the US market making sense to you, or is domestic pharma, which is a new investment theme, coming back in action?
Yeah, so like you rightly said. So the way we split pharma is into three. So one is the US generics, the second is the CRAM companies, and the third is the domestic pharma. So at the moment and for the last 1 year, we've been very bullish on the US generic space. And the reason for that has been that over the last 6-7 years, what we saw was a continuous price fall in the US
Yes.
generics. So anybody who has US generics was bleeding on the US generic part. You were seeing constantly drop in profit practically every quarter. Sorry, yeah, every quarter, every year or something. But now we think that US generics is more or less bottomed out. So that price fall is not happening, or it's happening at a very, very slow pace. So now there's a scope for the US generic part for your earnings to start going up because demand is fairly robust over there. So your volume growth and probably a bit of price drop or flattish prices, and that is taking your uh, growth up. So that is something which we picked up very early, and we picked up ahead of the market. Markets also now more or less grappling with the same situation. They said, okay, this is looking good, and stocks there look good because if you think of a normalized earnings over there, then they look cheap. Earlier the earnings were very, very depressed. On that they seem to be very high value, but on a normalized earning is cheap. The second space is we like the crime space. Now, this, mind you, is not a very cheap area because a lot of people like it, but the growth here can be very, very high. So we have one or two companies which are in niche areas, which we think will do very well over the next few years. You could compound earnings at 25% over there over, let's say, next 3 or 5 years. So that sort of growth which you can get, and they trade at like 20 times and also more reasonably priced also. The Indian pharma we actually used to have, and we've cut down relatively on the Indian domestic pharma now because we moved more to the US generics. But earlier we had a lot of exposure in the domestic pharma more than the US generic. So we are cutting domestic pharma and actually buying US generics as a trade.
That's a fair point. And the other rally that's going full steam within the pharma space is, of course, the pharma ancillaries and the hospital space. You look at how stocks like Apollo, which is the largest player, have more than doubled in the last 3 years or so. What talk about smaller players like Narayan Hirdalia or even Fortis? Is this a space which you find expensive?
So yeah, it's a space which is very interesting because just if you think of India's healthcare is very, very underpenetrated. At the same time, we think we are paying too much for future growth. So at the moment, like on a relative basis, we don't have a big exposure to the hospital space simply because of valuation. We think it's like the growth runway path which is huge, but at this price, we are a little cautious. Here, what you have to remember is like you have to keep adding hospitals along the way. So there's a lot of capex which comes up. So,
Yes.
every time a capex comes up, then you see some depression in earnings for short term till the new hospital takes off. So that is, the cycle which you have to play. Whereas, for a lot of the other pharma companies, it's like, the runway becomes very, very high.
Okay, let me just get back to your main portfolio, which is the Rising Star portfolio. There are about 35 stocks in this one, spread over smalls and mids. What would be the average market capitalization of this portfolio? You mentioned the PE being in the range of 60.
Yeah, so sorry, just on the Rising Star itself, we have only 18 stocks over there. So that's like
Okay.
so total we have 35 in our whole universe,
My
but
apologies.
yeah,
So 18 plus
Rising Star is
17.
18. And
Okay.
the average market cap, and this gets skewed because you have some very large cap which skews it, but average market cap is closer to 10,000 crores over there.
Okay. And over the last 3 months, ever since the rally has accelerated from this election day low, have you booked out on some mid caps and small caps and added fresh names? Or are you sort of continuing in the same universe that you are comfortable with?
So yeah, generally, as there are two things which why you sell a stock, right? One is you think that stock has become relatively expensive, and so you think the returns there may not be very high. Typically, we tend to look at a 3-year cycle. That over the next 3 years, where do we look at the stock price and what is the sort of return we give? The other thing, you sometimes sell a stock because you think it's good, but you find something better, then you have to create space in the portfolio to put that stock. So I would say very broadly, we have sold a bit of cement in our portfolio, and the reason we sold cement is we were very early holders of this theory that there'll be consolidation in the sector. And so we were like things which will get acquired because they trade very, very cheap. There were a couple of acquisitions, as we know, over the last, few months, which boosted a lot of these other smaller companies. And so we said that the risk reward there is no longer looking as good. And so we sold the cement names. If you think of like the fundamental of cement just now, demand growth has not been as robust as it is. So in general, cement prices have struggled to go up from the beginning of this year. So earnings will not be very good. And the valuations are crept up. So for us, it is we said, okay, let's say take some money off the table in cement. And so that has really been our trade.
Okay. And the fresh names that you've added towards this space is obviously private sector banks and some pharma.
Yeah.
Okay. Let's look at the large cap universe, Mr. Jaipuria. This is which is about 50% of multi cap portfolio, overall 600 crores. Now, in this universe, obviously relative value is much better within this space. How are you breaking up this segment within Valentis Advisors? What are the themes running into these large caps?
Yeah, so see, when we look at it, like for us, it's the overall portfolio, not just the large cap and the small cap. So very often, for example, in banks in the multi cap, we prefer to take a bank exposure through the large cap rather than the small caps because at the moment, a lot of the private sector banks are not, they're looking cheap. So it is like if you can get banks so cheap, then why take a risk with some of these mid cap names there? So that's one obvious thing. The other one has been telecom, which has been like a good favorite for us. That telecom, we think that the price wars are over. We're going to get price increases coming through. And here it is like a very simple. The moment you do a price increase, most of it just flows down to the bottom line because it's like a fixed cost sort of business. So to that extent, that has been the other thing which we have been looking at. We've been looking at some of these larger pharma names, obviously, over there also, and some of the larger cement names because those were standard themes which were paying. But also what we are now nibbling at and thinking about is some of the chemical names because the chemical names have underperformed quite a bit over the last 18 months. So both small cap, large cap, we are looking at chemicals quite closely, trying to figure that, okay, are we coming closer to a bottom of that cycle? And can we make big money if we get close to the bottom of the cycle? Our view is that we are probably still like maybe 2 quarters away from the bottom of the cycle, but at some point you have to start buying stocks a little early, start building your positions, and then when you get more comfortable, you add to the positions.
Wonderful. So that's how presently a large part of the portfolio is within the chemical, cement, pharma, banks, and telecom space. Mr. Jaipuria, what are you avoiding like plague that you're just not touching where valuations, despite corrections, haven't reached your comfort levels?
So see what one sector which we are very underweight on, and that's been there for the last many years, is not so much the valuation, it's just what we think of the earnings prospects. So this is all the global commodities. So basically
Okay.
the metals, especially steel. Because for us, China is the largest buyer. It's like accounts for nearly 50% of steel purchases. They're also the largest producer. And I think China is into a structural downturn in terms of the investment cycle. So China did very well for the last 20 years because the investment just kept going up and up. And I think they've reached a stage where the next at least 3 years, 5 years, you'll see a big downturn in the investment spend. So, when the largest buyer starts to slow down massively, then you want to be like very cautious on that sector. And that's what we've been tending to do. So metals is one space where we have been generally quite negative on, and we don't have too much exposure both in the small cap and large cap. So that's something we've been avoiding totally. The other one which we've been avoiding to a large extent is because of valuation has been the consumer staple space. That it just is too expensive for the sort of growth which it gives us. Great quality companies, but then at that price we've not found it very attractive.
Yes.
And so there, there's a bit of cyclical element because with consumer demand probably picking up after a decent monsoon, you could see some pickup in the business cycle over there. But for us, there are a lot of cheaper stuff you can get in the consumer discretionary, which would also gain from an improvement in the consumer cycle. So I would say the consumer staples are another space we've generally been avoiding.
Yes, this has had a time correction, but not a price correction over the last
Yeah.
5 years. So, fair point, you've avoided FMCG. Now, let's come to the most interesting part of the market, Mr. Jaipuria, which is the auto space. Thousands of crores of inventories are lying at dealers. Some put the number at 70,000 crores. Yet, we see consistent highs coming into stocks such as Ashok Leyland and to some extent even Tata Motors. Maruti is subdued, but look at two-wheelers. Post the Ola electric launch, they've been on fire and in top gear. How do you see auto? Is it represented in both Rising Star and multi-cap schemes?
So, we've sold all our auto OEM companies because from my point of view, there's a risk now that the cycle is peaked off and we'll get poor, volume numbers on a year-on-year basis. They'll not look great. So we're avoiding, generally most of the auto OEM guys. We have exposure to some auto ancillaries where, either they are doing something which is, so in auto ancillary, two, three things will happen. So one is, people add new components. So that helps them continue growth even if the OEMs are not doing well. The second is a lot of people are diversifying away from, like they have autos there, they are also adding maybe consumer goods or defensive or defense or something like that. So they are having a diversification which will ensure growth. Third is for people who are probably, on the export market, they were struggling a lot on export. Maybe there are some auto components which will see a reversal of that international business, where at least things will start looking a little better than they have over the last 18 months. So for us, it's like, in a environment where OEMs don't do as well as they did over the last 2 years? Are there auto companies which can still continue to do well because of some internal thing? And that is the ones which we are tending to play. But I would say on the auto OEMs per se, we don't have too much exposure at all now.
Okay, fair point. How about this expanding theme of PLI linked stocks? names such as Dixon, PG Electroplast, uh, Optimius, Virtuoso. So many of them have made fantastic money, and as a sector, it's one of those shining stars for many fund managers. Have you stayed away from them because of valuation concerns, or is this a growth area which Valentis wants to look into?
It's definitely a growth area, and a lot of these companies will do well. The question is that today's valuation, how much is the margin for error? And
Yes.
for that, because generally we have this whole theme which we play the three U's. This is for us, not a space which we are really getting excited about because there are a lot of expectations already in the valuations which are there. So in case something goes wrong, then the margin of safety is very low. For us, the key always is margin of safety in any of these stocks.
Okay, from the conversation that I have been able to understand over the last 25 minutes or so, Mr. Jaipuria, like most of us, you're very comfortable with companies that have 15, 17, 20-year track record, so that you can gauge the seasonality, you can gauge the industry cycle, and then maybe buy at the bottom. Is there a risk that for your unit holders, you are missing out on maybe the PLI market, maybe the new age internet themes, maybe the quality SME names? Is that a fear that worries you?
So one is, we don't necessarily buy stocks with a 15-year track record because in our rising star, we actually have a lot of companies which in some sense we've more or less seeded and nurtured like a private equity player. So a lot of
Okay.
companies who were very, very small, but there was not a single institutional player there. We were the first guys to enter. There was zero expectation there. And so, like a lot of them have become multi-baggers and now mutual funds have bought the stock, we got out of it. So, that way we have a lot of stocks there. But in some sense, you're right in the sense that we'll miss some. We're not going to like get everything right because, for example, the whole PLI space or, maybe the defense space, there's a big long-term 5-year story, but then for us, it just sounds too expensive. At the same time, we stick to what we understand well because if you miss a defense, but you get something else which gives you similar return, it's good enough. Ultimately, you have to get a return. You don't have to bother about, how you got the return. So we stick to our fundamentals. We stick to what we understand best rather than trying to do whatever works in the market.
Fair point. I think investors should be more concerned with where and how much money is coming in rather than which stock is delivering the best return. A couple of other points on the overall hygiene of the market, Mr. Jaipuria. You've been a 3-decade veteran, and there are two, how should I say, blaring red lights in the market, which is consistent selling by promoters and this never ending mutual fund supply from new sectoral themes and sector specific launches. Are these really red lights to your mind, or we need them because liquidity is so less in the market and money being pumped each month gets expanded month on month?
Yeah, so see, it's definitely not a market which is very easy, right? I tell people the easy money got made in the last 3 years. We'll not make similar sort of returns for sure in the next 3 years. We'll get a lot more volatility than we had in the last 3 years. So, whether it's the promoter or you or me, everybody like operates in the same market. What you know is like valuations are not cheap. At the same time, growth is continuing, and valuation by itself can remain little expensive for much longer than what one thinks. So hopefully, the money will get made. We'll still make like maybe, double digit sort of return in the market. But it's definitely like you have to be a little cautious. You don't want to be all guns blazing and now that say, this market will never fall because there will be corrections on the way. And for people who've not seen a correction in the last 3 years, they may get a shock at some point when corrections are like steeper and they don't like it falls today, then bounce back tomorrow. I think people have forgotten that correction lasts for much longer than 1 or 2 days also. I think
Yes.
we'll get it. There've been like 3 years in the last 25 years that we've not seen a 10% correction during the year. One of them was last year. And even this year so far has not seen a 10% correction. So I think we'll get it at some point. And, people should be ready for that correction also.
Mr. Jaipuria, I think all Indian investors, especially the retail set, have taken this buy the dip strategy to their heart, and they are religiously practicing it. August saw many pain points, and yet the Nifty is now at a record high and perhaps looking higher still. Just based on mathematics and this unending flow of money into the markets, where do you expect the Nifty 1 year from now?
Oh, that's like, so generally I would say that over the next 3 years rather than think of 1 year, because 1 year could go anywhere. Because if you go back into history of the Fed cuts, you can pick up two instances where market was negative 1 year later after the Fed cuts. And of course, somebody else can pick up other instances where it was positive. So, I would think that the market over the next 3 years would give us, low single digit to or high single digit to low double digit sort of return. Because, the earnings will probably average around 12 to 13%. And probably there'll be a bit of valuation correction on the way. So, probably somewhere around that, maybe 10% if you really want to pick a number sort of thing.
Okay, with that, Mr. Jaipuria, we'll call it time on this wonderful episode. Here's wishing you all the best, and to your shareholders who will make supernormal returns on the base of your wonderful stock picking. And here's hoping that fabulous amount of money is made across all market capitalizations in India over the next many decades. Thank you for joining us.
Okay. Thanks a lot. Bye.
That, ladies and gentlemen, was Mr. Jyotivardhan Jaipuria, founder and managing director of a very well-known PMS Valentis Advisors Private Limited. He manages 1600 crores over 35 stocks and is nibbling into private sector banks, nibbling into pharma, and of course is underweight into metals and is avoiding PLI and auto OEMs. That was an interesting conversation. I hope you enjoyed it as much as I did, and please remain glued to Business Today Television. There is more coming on the other side of this break. Thank you for watching us.
Modi government launches game-changer Unified Pension Scheme, aimed at providing assured pension, family pension and assured minimum pension to the government employees. Unified Pension Scheme assures 50% of basic pay as assured pension after minimum 25 years of service. Under UPS, 60% of the pension amount will be given to the kin after demise as family pension. UPS